Well, welcome to part 5 of why the housing market will crash. All right, so this is the video you've all been waiting for. This is the video I said you don't want to miss, where we're kind of wrapping it all up in this video. Why I'm bearish housing in Australia, but also globally. And look, I will do another video which I'll release next week, and it'll just be bits of information and some clips, some really cool little videos, some clips that I just couldn't fit in this series. Otherwise, this would go on for hours and hours and hours. So, so next week's video, there'll be a little bit more information on the bond market, the corporate bond market, immigration, maybe a bit on Airbnb, and a little bit more information about what we covered today, plus some really cool little clips. So after you watch this, if you do want a little bit more information, I'll share that in the video next week. So how bad will the looming mortgage cliff be? Well, a lot of people have dismissed this mortgage cliff, this people coming off fixed rates. 350 billion of credit expiring, and well, I can say that about 45% of all those fixed rates did revert back to higher variable rates at the end of July. By the end of July, however, since then we've got a lot more people coming off fixed rates, and you'll see it in the charts. But what I argue is you're not going to see an impact straight away. People have got savings. People will be hit, but people will spend down their savings. And so what I say to people is wait 6 months. All right. So the people that have already rolled off, we're not going to see the real pain for them until 6 months later. So, Christmas is going to be difficult for those people. But the rest of the fixed rate borrowers that are rolling off now, we'll see that in the early part of next year, in the first and second quarter of next year. So give it some time. So let's get into this. So you can see from this chart that back in 2020 and 2021, interest rates fell really, really low when the RBA dropped the cash rate to 0.1%, provided the TFF, the Term Funding Facility, the 3-year, $188 billion term funding facility, enabled banks to offer really cheap fixed rates, especially in that 2 and 3 year fixed rate market. In fact, I sent an email out to our clients in November of 2021 when you could still get a 4 and 5 year fixed rate sub 2%, 1.99. I sent an email out to clients saying, hey, look, and I shared charts of the bond market, and I said, look, interest rates are going to go up no matter what the RBA does. Mortgage rates are going up, and you may want to have a look at, maybe locking in these fixed rates. We have tens of thousands of clients. Guess how many got back to me and locked in a 5-year fixed rate with ING at 1.99%? One person. Why? Because they were listening to later on in 2022, when they started coming back to us when interest rates had risen. We asked, did you not get our email in November 2021? And they said, yeah, we did, but everyone in the media, all the economists said rates aren't going up till 2024, so we didn't believe you. So there you go. And here you can see new home loan commitments. So in fact, according to the RBA's financial stability review that they only just released, I think on the 6th of October, it was actually around 40% of all mortgages that were fixed between March 2020 and January 2022. So that was a huge amount of people that fixed their mortgages during that time. And unlike the US, we don't have 30-year fixed rate mortgages. We have 1 to 5 year predominantly. We've got a couple of lenders that will do 10-year. That's it. So you can see this chart that the majority of those fixed rate borrowers have now rolled off, but we still got significant amounts of people rolling off their fixed rates. So you can tell that this chart is a little bit old. I've been meaning to put this video together for some time because this is how much extra households will have to pay when their fixed rate loans expire, assuming interest rates were fixed for 3 years at 2.48 and will be refinanced at 5.58. Well, pretty much all interest rates are over 6% now. All mortgage interest rates are over 6%. You can get there are a few lenders that you could get sub 6%. I think I saw some of our brokers just submitted some loans with some banks at 5.584 or 5.89 or something like that. So you can slightly get under 6%, but for most borrowers now you're over 6%. So the extra repayments just on the mortgage alone is a lot more than this. In fact, according to the RBA's financial stability review, I think it's 60%. So 10% of borrowers who have rolled off fixed rate mortgages since May 2022 have seen an increase of more than 60% in mortgage repayments, with another 14% expected to join them. So actually, there's more people that are about to join that group than there was prior. So will households be able to afford their repayments? Well, our silly Keynesian economists are divided over that. Some are saying, oh, no, all good, soft landing, soft landing, soft landing, all that sort of stuff. Well, they should come and spend a couple of days in my office and see what's actually happening in the real world. So this chart here, household mortgage prepayments by month. So the number of months ahead of their repayments. Now you can see that new loans originated during 2021 and 2022. So these are what we call the first home buyer lambs to the slaughter. Over 10% have less than 3 months, ahead of their repayments. In fact, almost 10% are only just on meeting their repayments. So they're not ahead. They have no buffer. And when you look at the fixed rate investor loans, well, you can see how high this is getting. And in this chart, so you can see this is a distribution of changes in spare cash flow. And this assumes, you can see down the bottom, this assumes that a cash rate of around 3.75%. Well, the cash rate's 4.1, which, by the way, I actually predicted in that November 2021 letter. However, I now believe we will see another rate rise, 4.35, and I wouldn't rule out 4.6 in this cycle. However, my argument is that interest rates will be much, much higher later this decade, thanks to the government's energy policies and the hollowing out of our economy. So enjoy these rates while they last, because later this decade they're going to be much, much higher, because CPI is going to be much, much higher. But that's for another time. You can see this at 3.75%, that cash flows become or remain negative, almost 20% of households. There you go. And here, loans unable to refinance. These are mortgage prisoners, 15, 16% to 20%, between a cash rate of 3.6 and 4.6%. And yes, some people say, but Steve, some banks have come out and they've reduced their buffers, their serviceability buffers. Look, it's not increasing people's borrowing capacity. They can't go out and borrow more funds with that. You cannot refinance to a lender with these reduced buffers until you've come off your fixed rate, and your rate has to be higher than that, than the rate that you're moving to, and you have to have a perfect payment history for the last 12 months just to move to that. So there's no extra borrowing allowed to do that. So it's going to have zero impact, in my opinion, on borrowing capacity to buy more properties. But there's going to be a big amount of people who are going to be mortgage prisoners. Now, for those who think and are screaming of high interest rates by the RBA, well, actually, when you look at a longer-term chart of the RBA cash rate and then your CPI, you'll actually see that the RBA cash rate on history has been above CPI, and we haven't been there for the last several years. So, even though CPI is coming down at the moment in this cycle, I expect CPI to go up later this decade. So enjoy that. The RBA cash rate is likely to go higher. We've got a lot of structural problems now with productivity. And I've talked about this before. So, yeah, watch this space. So here's a chart when the fixed rate, fixed loan expiry across all the different lenders, and you can see that we've now peaked. Okay, so we've only just peaked. This is what I'm talking about. We need to wait for the pain. For these people who have already rolled off, we need to wait for the pain. But you can see that there's still more fixed rate borrowers that are going to roll off to higher rates, even into the first quarter of next year. So, the pain hasn't begun yet, folks. So I love this chart from CBA, fixed rate loan expiry. This is for CBA only loans, so Commonwealth Bank of Australia. And you can see we've only just hit the peak in their loans that have rolled off fixed rates. Okay, so you can see the red line is the cash rate at origination, and the cash rate at roll off at 4.1, which I think is probably likely to go to 4.35, maybe 4.6 in this cycle. So, yeah, there's so much more pain to come. We haven't even really started this mortgage cliff yet, and people are already going, mortgage cliff? What mortgage cliff? Oh man, wake up. And just another chart of fixed rate mortgage expiry schedule. You can see there's still a lot more fixed rates to expire yet. What is it? Another 100 billion to expire over the coming quarter or the coming 2 quarters. I can't remember exactly. As I said, the pain hasn't even started. The mortgage cliff, is only just peaking. Give it time, folks. Unless the cash rate's going to be cut, 2 or 3 or 4%, which it ain't. Oof, this is going to be painful. So from Jarden Research, we are at the peak of this fixed rate cliff right now across July, August, and September. Jarden estimates more than 30 billion worth of fixed rate loans will expire each month, increasing many households' monthly mortgage payments by 50%. So increasing. So yeah, so $100 billion just in this next quarter alone. Now, a lot of clients say to me, Steve, I want to buy investment properties because rents have risen so much, and it's so cool. Like, it's the best time to buy an investment property because my rental income's just going to rise and rise and rise. Well, I love this chart. Mortgage repayments as a percentage of income is at all-time highs now. Cool. And buying versus renting in Sydney. So this is Sydney-centric, the bottom chart. But have a look at the rent to income in the dark blue line, and then the repayments to income in red. Mortgage repayments have gone up 60% for many people. Rents have not gone up that high. So if you bought an investment property because you thought, well, the rent is going to go up more than mortgage repayments have gone up, you're crazy. Look at the spread. The spread is now at all-time highs. I always say that property investors are the most sophisticated investors I've ever met. That's also sarcasm if you didn't pick that up. So this is a really interesting chart, the distribution of debt to income ratio. So these are new loans up to the June quarter of 2021. So DTI, debt to income. Now have a look at the 6 to 8 and 8 plus. So if owner occupied, you've got well over 20%. 22, 23% of owner-occupied loans, new loans in that June quarter of 2021 or up to that June quarter of 2021 had a DTI well above 6, all right? And investors well above 30%. So when we look at this chart and look at on the left-hand side, so this is this is a mortgage debt to income ratio versus mortgage rate, percentage of gross household income on repayments. That's gross, not net. So this is before tax. Look at the 6 times. Now go across to 6% because I said all mortgage rates are pretty much above 6% now. You're looking at 43.2% of your gross income just going on mortgage repayments. And for those above 8 times, that's nearly 58% of your gross income going to mortgage repayments. And if we still get another couple of interest rate rises, I think we'll definitely get one more. another 2. Well, ouch. And this is a cool chart that just shows the massive increase in new loans of debt to income above 6 times household income over the last couple of years, or during that debt binge period. And Australians lead the world in mortgage paying, according to the IMF. Australians devote a greater share of their income to mortgage payments than any other advanced economy, the IMF has revealed as it downgraded its forecast for the local economy and warned inflation will be higher than previously thought. Who's been saying that? And here you can see the chart down below. Australia, gold medalists. Woohoo! We're debt junkies.
The bubble historian who is eager to see them. Are you guilty of being too eager to see one now?
I don't think so. I think everybody else is guilty of the usual crime of expecting a soft landing when it never comes, but is always claimed, believing the Fed, who has never gotten one of these bubbles right, regardless of the fact they have involved several different Feds.
They help create them. They don't see them.
Underestimating the time that it takes for some of these things to work through, particularly real estate. And I'm sympathetic on that one because real estate is a global bubble. It has driven house prices provably to multiples of family income all over the world. China, Beijing, Shanghai, you tell me, 15 times, 20 times family income, Sydney, Adelaide, etc. Canada, the UK, London. There used to be multiples of 3.5 times family income. London is now 10. Toronto's worse, etc., etc. No one can afford to buy a house now. Yeah. No young kids coming out can buy a house. This is not a stable equilibrium. Furthermore, the mortgages have gone from 3, which explains everything, to 7, which explains nothing. And eventually the 7 will start to explain quite a bit. But how long does it take? I mean, just think. The first reflex is, I can't move, for God's sake. I can't afford to go from 3 to 7.
Sure.
So I am going to stay, which means no houses are on the market, which means for the handful of people who have to move, they're actually in a bidding war.
And prices stay up.
Yeah. But so real estate has never been about 3-month predictions. It works slowly but surely. In the end, you pay more because you could afford to. In the end, you will pay less because you can't afford to.
And here, secret RBA documents reveal even high-income and middle-class Aussies are in financial crisis. Details of briefings inside the Reserve Bank that you were never meant to see have been released, and they are showing growing concern about a rapidly worsening crisis. So let's have a quick look at this article about this secret RBA document. Secret briefings inside the Reserve Bank reveal a startling surge in the number of middle-class Australians on 6-figure salaries seeking a financial crisis support. In July, members of the RBA's Financial Stability Division met with representatives from the National Debt Helpline, a resource offering those in need access to free financial counselling. Engaging with the service is often a requirement of banks when borrowers are unable to meet some or all of their home loan repayments, but anyone in distress can seek help. Now, I shared something like this on Twitter recently. So we interviewed a lady who's now coming to work for us. I won't go into any details, but she headed up the arrears department, a particular arrears department at a particular large bank. And I just happened to ask, arrears increasing or decreasing? And she said that arrears had skyrocketed from what they were. I then asked her questions like, well, what do you do with them? She said we refer them to this debt helpline. They have to get advice and help from debt helpline. That's part of the requirement. And then I said, so what's their situation like? Are they likely to, get back in front on their mortgage repayments? And she said highly unlikely because their cash flow position is negative. They are in a terrible. They've got no savings. They've spent all their savings, living week to week, and they're spending more than they earn, and they're just falling into much larger debts, and they're just using credit cards to pay their bills. They're buy now, pay later, all that sort of stuff. So, and she was done with it. She's like, I've had enough of this. This is only going to get worse, and she wanted to change. So, anyway, I shared that on Twitter, and man, people went crazy. Like, you're lying, or this person's lying, and it's not happening, and blah blah blah. Well, right here in the RBA's financial stability report or review, it's been found that no, that is actually happening. They reveal the NDH has seen a significant increase in hardship requests over recent months, especially from Aussies running into strife for the very first time. The NDH has experienced an increasing volume of calls from people who have not experienced financial hardship or drawn on social services previously, the memo reads. Many callers were gainfully employed. Examples were given of mortgagees on six-figure salaries residing in prosperous suburbs in Sydney. The new cohort of solid middle to upper income callers is among a significant number of callers now relying on credit cards, loans from family and friends, or buy now, pay later schemes to get by. Some are avoiding obligations to the ATO, good luck with that, or deferring their utilities and council rates bill, good luck with that as well. Additionally, underinsurance was becoming an increasing problem. Borrowers did not have enough spare income to pay insurance premiums for their homes. Oh man, cars or personal belongings. And some borrowers were asking about how they could qualify to tap into their superannuation balances. Data from the ABS for the June quarter showed the value of household deposits accounts plunged by $6 billion, the first fall recorded in 16 years. I'll come to that shortly. Separate ABS data shows the cost of food jumped 7.5% year on year in June, with 15.2% increase in dairy products and 11.6% increase in bread products. Utility bills were up 12% to 14% higher than a year prior, while insurance costs leapt 14%. Mine have gone up way more than that, but anyway. Representatives from NDH shared examples of harrowing cases of distress, but said surging demand means it's several weeks until someone gets an appointment with a counsellor, if at all. Demand is expected to increase over the coming period, particularly since seeing a financial counsellor is required by lenders for those in hardship arrangements, and the full effects of high interest rates and cost of living pressures were still filtering through. Remember in a previous video I talked about what real wages are doing? Yeah. It was noted that even a modest increase in unemployment would impose a call on counselling service that would not be met with current resourcing budgets. And a record 4% increase in interest rates since mid-2022 has seen many Aussies worried about being forced to sell their homes, the memo reveals. Instances of NDH callers reporting housing costs accounting for between 50 and 70% of their disposable income were not uncommon. Remember that chart I just shared with you before? People with 6 times DDI and higher. It was 43%, wasn't it, of their gross? That's gross. This is, net of their disposable income. It's not uncommon. Now, I like to follow Martin North and his digital finance analytics, and well, his most recent data shows that mortgage stress has hit an all-time high of now 50.1%. That's 50% of households. And by the way, his mortgage stress is measured on a cash flow basis, cash flow in, cash flow out. So it's not the 25 or 30% of income, et cetera, et cetera. So 50% of households that he surveys are in mortgage stress, meaning they've got more outgoings than they've got incoming in income. Yet go back, just over a decade ago, and it was below 15%, 13% mortgage stress. Go back, nearly 2 decades ago, it was about 10%. So, and yeah, don't start on the rental stress. That's out of control, nearly 70%. So I've shared this chart once before. Australian housing market, wages, interest rates, and RBA limitations. And this is ABS median wages and median, house prices, et cetera, et cetera. And it says down the bottom, where can RBA raise rates to? Because at the time, the cash rate was 0.1%. So 2021, 3%. Annual income, this is median, 90 grand. Sydney median house price 1.6 mil. You know, when you got 80% mortgage at cash, repayments as a percentage of income, house price to income ratio, debt to income ratio, deposit to income ratio. You can see here that the repayments as a percentage of income, well, at 3% was 71%. That's mathematics doesn't add up in that case. Debt to income ratio 14.18. Now we know the RBA cash rate is at 4.1. So, yeah, there's two things, folks. There's mathematics and economic laws, and everyone's betting against most Australians, and I'd say most Canadians and Americans, British, you name it, Kiwis, are betting against mathematics and economic laws. I'm betting that mathematics and economic laws win out in the end. So in this chart, you can see higher loan to income ratio, so LTIs, when you use a baseline, a broader HEM measure, almost 50%. So this is marrying up with Martin's data in many ways. Nearly 50% of borrowers' cost of living exceeds their income. And then you got high LVR over 30%. Etc. Mate, this cannot continue for a period of time. And 1 in 20 mortgage holders in distress, according to the RBA. Surging interest rates and the cost of living crunch has left 1 in 20 borrowers unable to cover the very basic essentials, according to new Reserve Bank analysis. And this is using baseline HEMS. Now, mortgage brokers, we understand what HEMS are. We use it all the time. Most clients, 99% of clients, their actual expenditure is much higher than HEMS. HEMS is just used as a baseline figure. But if we use a more broader HEM measure of expenses, that figure of 5% actually rises to 13%, which is up from 3% in April 2022. So these are people who can't cover the very basic essentials. So 5%. Now think of these, keep these numbers in the back of your head. 5% and 20% and all this. Keep all that in the back of your head, because I'm gonna talk about something shortly. So I've worked out that 386,100 Australian household expenses exceed their incomes, and that doesn't include renters. And this is via the RBA Financial Stability Review. So here's a chart that just shows, using a broader HEM measure, that figure of basic living costs, right? Borrowers' cost of living exceeding income is at 13%, on its way to 15% and higher. And those of you that watch ABC, I don't, borrowers, just talking about it, Alan Kohler talking about it, like that's trending up to 15% and beyond. This is basic living costs. Yeah. And wait till the mortgage cliff really kicks in, and then wait for the other people to roll off their fixed rate. This isn't just low income people. This is a lot of people. And borrowers face tough loan battle. More than 2/3 of mortgage holders will not be able to cope with another interest rate rise, new research shows, as higher cost of living pressures deplete household savings. Well, get ready, because it's coming. The survey from financial comparison site Canstar found that following 12 interest rate rises, which have added more than $1,200 to the monthly repayment on a $500,000 loan. Man, who has a $500,000 loan these days? Just 31% of respondents felt confident they could continue to meet repayments if there was another hike. The findings also showed that 8% of borrowers were stressed because they were already behind or struggling to keep up with loan repayments. So 8% are already behind. That's a delinquency. As soon as you miss a repayment, you're delinquent. So 8%. Keep that figure in the back of your head. So how much more pain can borrowers take before they break? The resilience of household borrowers in the face of surging interest rates has surprised Reserve Bank researchers, but things could get uglier from here. Record-beating mortgage pain set to get worse. RBA, your already record share of income household spend on mortgage repayments will increase even further, the Reserve Bank has warned, causing borrowers to dip into savings to meet the rising cost of living. We just got one problem with that. Australia savings buffer gone by March, consumption to take a hit, fixed rate mortgages, government lockdown era, savings and a hot job market have sheltered Australian households, but the dominoes are falling and economists worry the savings buffer is almost gone. And yep, we're seeing real household consumption begin to fall, and I think it's going to fall quite a bit. And if you go back to, I think, part 3 of this series, where I'll share how really hollowed out our economy is becoming and productivity is just in the toilet. And here's a chart that just shows the changes in outstanding mortgage rates since the end of June 2021. And you can compare the different countries there. So I've shared this chart before. House prices have grown much faster than income since the mid-1990s. So what has caused this increase in house price and this divergence between incomes? So Scott Phillips from the Motley Fool wrote this piece back in May 2021. And look, I don't see eye to eye with Scott on many issues. We're kind of on opposite sides of most things. However, there's a few good points that he makes on here in this article. How on earth do you justify Australian house prices? So let's just touch on some key points that he shares in this piece. So the first thing he argues is household incomes. So over this, the last 40 years, we've had a bond bull market. We've also seen an increase in employment patterns, including larger female workforce. So when there was one family income, now there's 2 family incomes. Most households now have 2 family incomes. So that's resulted in a significant increase in household income. With the 2017-18 financial year, average weekly household income at $2,242 before tax, up from $1,361 in 95-96. So that's an increase of 65% in just over 20 years. So that's definitely increased people's income, which obviously helps towards borrowing power. The next thing he says is loan terms. So, yep, when I first started as a broker, the standard loan term was 25 years. Now the standard is 30 years. So if he wanted to borrow $800,000 over 25 years, according to ASIC's Money Smart calculator, the repayments at 2.4%, now we don't have those rates anymore, do we, would be $3,549 a month. But if I pay it back over 30 years, instead, I can now borrow $910,000. So by increasing the loan term, the borrowing capacity does increase a little bit. And then he says, let's go to the big one last, interest rates. He says interest rates on home loans hit 10.38% in July 1974 and stayed at around that level until September 1980. And as we just saw from Money Smart, the current rate is 2.4%. Well, it's not now. You guys know what it is now. Let's do the math on the same 25-year loan above at 10.4% rather than 2.4%. I'm using 25 years rather than 30, so we don't double count the factors. Instead of $3,549 per month paying off an $800,000 loan, I could only borrow $379,000. So falling rates have more than doubled my borrowing capacity. So this is our bond bull market. Bond bull market means as rates go down, your borrowing capacity goes up. And what I argue in our second part 2 of this video series is that we're now in a bond bear market. That bond bull market, that wind behind us has now shifted, and that wind is now in front of us. So wrapping it up, he says, let's start adjusting for those factors. My first rough guess on the impact of second incomes, if we assume 1, household incomes are up around 42% because of more women entering the workforce, and 2, 2/3 of that extra income gets put towards mortgage repayments. then the average household can afford to pay around 28% more for a house these days, or in the past, it was 28% less. So for the individual, let's say the monthly repayments fall to $2,772. Let's go back to a 25-year loan, and let's increase the interest rate to 10.4%. My borrowing capacity falls from $910,000 to $296,000. With a 5% deposit, I can only buy a $310,000 house rather than one selling for $955,000. Or expressed another way, the impact of more women in the workforce, longer repayment periods, and lower rates means we're now able to pay more than 3 times as much for a house as we might have 40 years ago. Some good points there that I agree with. Now, when we look at Australian average house prices, actual house price and affordable house price, you can see that the correlation is very good. However, affordable house prices have fallen. Actual house prices now bounced. So they did start to fall, but they've now bounced. So this is the same chart. So it just means the actual median home sale price and the capacity to pay. So borrowing capacity with a 20% deposit, average full-time earnings, and mortgage repayments at 28% of income. All right. So this has been the case for the last 40 years, bond bull market. All right. My argument is that these lines will meet up again. So the question is, does borrowing capacity increase? So do we see, I don't know, maybe 99-year loan terms? Because everyone's kind of two income households. So unless we're going to start making the kids work and then contribute to the mortgage repayments, unless interest rates are cut back to 1-2%, or unless we see some pay rise of 20-30% a year for the next several years, I don't see how borrowing capacity can increase and get back to where actual median home sale price is, or increase to push up house prices even more. In fact, you guys probably wondering why I've got Michael Burry on the thumbnail of this video. Well, let's cut to a very short, quick clip from Michael Burry.
Fannie and Freddie are basically being used as special purpose vehicles by our government to support the housing market. The private mortgage market is practically non-existent. 96-97% of mortgages are flowing through Fannie and Freddie now. It's I think Fannie and Freddie are exercising a tremendous amount of power over the market by withholding properties from sale and not forcing the foreclosure process. I think that it'd be best if the government just completely got out of the mortgage market and let the housing, because home prices are a function of income and the leverage applied.
So there you go. Now, recently, I've shared with our insiders about this book, The Price of Time by Ed Chancellor. I've read it twice. I am now reading it a third time. But this time I'm taking notes and making highlights throughout the book, so it's going to take me a bit longer to get through. Ed does a really great job going through the history of interest rates. And when I recently read it for that second time, I picked up on some things that either I looked over or missed the first time around. And the big thing that stood out to me rereading it a second time was that John Locke and Adam Smith, they wrote about houses and land prices years ago. And just as Michael Burry just said, a house price is a derivative of income and the leverage applied, aka borrowing capacity. Well, 350 years ago, John Locke wrote about land prices, and 247 years ago, Adam Smith wrote about land prices and how interest rates and income determine the price of land, i.e. borrowing capacity. They argued when interest rates go down, people's borrowing capacity increases, and when interest rates go up, people's borrowing capacity goes down. And as per that last chart from AMP that I showed, those two lines are going to meet up again. And as I said, the question is, does house prices come down or does borrowing capacity increase? I'm betting one way, most people are betting another way. So I'm definitely in the minority there. And by the way, if you haven't read Ed Chancellor's book, do yourselves a favor and read it. It's now in my top 10 favorite books of all time. while you're at it, Ed did mention a lot in this book about one of my favorite Austrian economists, and that's Eugene von Bombarwerk, who wrote the book Capital and Interest in 1890, and also wrote a book called The Positive Theory of Capital, which I highly recommend reading. In fact, you guys can download a free copy of that as an e-copy from the Mises Institute. So why are we seeing a bounce in home prices after they started to fall? Well, new loan commitments. It's literally the definition of inflation. How are new deposits created? How is money created when you take out a loan? Well, we've seen lending increase, which has bounced house prices. It's pretty simple. Now, I argue that this isn't immigration doing this. In fact, I believe, based on what I see within our business, that most Australians have created FOMO in their own head, thinking that it's immigration that's causing house prices, so they need to jump on the train, borrow up to the hilt, and get in, or they'll the train's going to leave the station. They'll never be able to own a home, and it's them that are increasing the borrowing, which has seen this uptick in housing. So really, it is inflation 101. It's the Cantillon effect 101. And I've done a video. I'll put it in a link. I'll put a link in the description below. Inflation Explained, the Austrian definition of inflation. And this is so basic. Now, by the way, this video is one of my earlier videos, so the quality of this video isn't that great, but the content in it explains exactly what we're seeing today. So while new loan commitments is still above the trend, we are now starting to see some data that this is now rolling over and heading down. So I wanted to actually share a chart. I was trying to find a chart for this video, which shows, I can't remember if it was M2 or it was just money supply and housing and the price of housing. And it literally for the last 100 years just goes perfectly in line with each other. But this is what I found: Australian bank lending and value of land. So residential land value as a percentage of GDP, and bank credit as a percentage of GDP. It's just inflation. So I actually argue, have you actually made wealth in real estate? Or has your dollars just simply been devalued? So here we go. We're starting to see credit and broad money growth contract. So watch your space. Here, new housing lending for CBA has just ticked down. So that bounce, it's now rolling over. And also CBA investor housing credit now weakest in 3 years. And Bank of Queensland Group anticipate increasing risk in the financial year of 24. The banking group has seen a dramatic drop in home lending growth, warning that the elevated cost of living, lagged impact, and sustained high interest rates are all causes of concern in the financial year 2024. And off that, the Bank of Queensland shares hit 16-month low. And AFG, Australia's largest mortgage broking aggregation group, reports drop in lodgement volumes. Yep, here we go. And it's not just in Australia. Mortgage applications to buy a house is falling to its lowest level since the early 90s in the US. And here's another great chart showing existing home sales and mortgage rate. So as the mortgage rate has increased, now a lot of people locked in very low 30-year fixed rates over there, and they ain't going to refinance. Actually saw I won't go into it. So watch this space. Now, interest rates are not high, folks. Historically, interest rates are only kind of getting back to normal levels, especially when you look at real mortgage rates. What we experienced over the last few years was insane. It was insane. And central bankers, this is why I argue in part one This is the Austrian business cycle theory playing out. We saw the first part of it. Now we're going to see the second part of it. And here we go. Household deposits, turning point. Total residence deposits, households, the billions. Look at that. For the first time, it is turning down. So Australians are running down cash, spend and put into shares, deposits and currency held by household. This is the first fall in 16 years. So this is consistent with broad money series published by the RBA. Household deposits have fallen for the first time in 16 years. And remember how our banking system works. All right. Loans create deposits. All right. So how is currency created? How is what people think is money is created? It's when you take out a loan. So this right here is a leading indicator for credit growth. And another great chart here, household business and total deposits growth. Business deposits or business deposit growth shrunk well ahead of households in the previous cycle, and it's doing the same thing again. So this is a leading indicator, as I said, for credit growth. Now, the way our system works, we need more loans. It's a Ponzi scheme. We need more loans to continue each and every year. Otherwise, there's not going to be enough income, not just to pay back the debt, but the interest on the debt. And credit contraction is here. Only happened during the financial crisis. And from David Taylor, this is interesting. The household sector drew down on deposit assets for the first time since June quarter 2007, ABS says. To be clear, this isn't saving less. It's actually dipping into savings to the tune of $6 billion. Savings peaked in May of this year at $300 billion. And all reports is come March next year, people's savings will be exhausted. And from Shane Oliver, this is the Westpac survey, Melbourne Institute survey, that shows households are continuing to favour less risky choices for their savings, with bank deposits and paying down debt over real estate, shares and super the preferred option. In fact, you can see from this chart that real estate is pretty much at its lowest level.
That should have been a leading indicator for us on peak froth in the mortgage market that, Pitbull, fireworks show, aircraft carrier. We should have seen something then. Unfortunately, I think we know how it all happened. The market, after $4 trillion years, reverted back down to around a 1.7, and we'll probably finish around something similar this year. And the MBA forecasted another 1.7, 1.8 trillion kind of market. So, roughly cut in half compared to 21 and 22 volumes. So it's not happy times in mortgage land. And those that do have their 3% 30-year fixed rate mortgage are hanging on to it. So there's not a lot of prepayment coming, not a lot of cash coming back into institutions. That's causing some liquidity concerns for depositories because they're just not getting cash flow back. Fewer loans are being made. It means less gain on sale is being generated by institutions as they originate. And when they try to trade those loans that they do own at a below market rate, it's often at a discount.
All right. So what's interesting is when you look at people who have bought homes in the last 2 or 3 years, are now reselling. So they bought at the top of the market. Interest rates have gone up. People are hurting. And if you look at this chart, Brisbane is actually leading the way with resales within 2 years. But Steve, Brisbane has the Olympics. That's going to push property prices up. And distress selling on the rise, according to McGrath Real Estate Agents. Southwest Sydney, Gold Coast are most likely to default. Getting out before the rush, private investors quitting property. Property prices have been rising for 8 months in a row and rental demand is surging. So why are investors quitting the market now? Because it may be their last chance to get out of the market at prices which are 4% higher than a year ago. Industry analysts say a mixture of sharply increased holding costs and a mixed outlook for further capital gains has combined to trigger a run of investor sales. For many long-term investors, this spring auction season has been a long time coming, and the opportunity window to sell investments may not be open for long. Nearly 1 in 6 units sold at a loss in Sydney with Strathfield LGA, local government area, worse for sellers, new property data shows. 1 in 5 borrowers is screwed. The Reserve Bank of Australia likes to spin that most borrowers are fine, but between 15 and 20% are in trouble. So Chris Joy goes on and says the calculus here is simple. Global unemployment rates are near all-time lows. Global wage growth is consequently brisk. Global labour productivity is exceptionally poor because businesses are employing too many people for the products they are purveying. This means that wages minus productivity or unit wage costs are rising at a highly inflationary rate of 7 to 8% in Australia and New Zealand and 6 to 7% in Europe. In the US, the unit wage cost story is more benign at 3 to 4%. But to get inflation back to central banks' 2% targets, unit wage cost growth needs to be at a similar level, which it's not. Now he goes on to talk about the arrears spike. Our analysis over the latest monthly insolvency data from ASIC casts this into sharp relief. In August, 817 Aussie businesses went bust in seasonally adjusted terms, the highest since 2015. The key, however, is the direction of the trend line. Insolvencies look like they are heading a lot higher. We're also seeing a structural break in the delinquencies reported on home loans issued by banks as opposed to non-banks. The 30-day arrears rate on bank home loans that has been securitized or sold has bumped from 0.6% to 0.8%. Yet if we look at prime loans issued by non-banks, the 30-day arrears rate has spiked by 50% from 0.89% to 1.34%. One examines subprime home loans originated by non-banks. The news is worse, with the 30 days arrears rate leaping from 2.5% to almost 4%. Remember, keep these figures in your head. This very much accords with the RBA's research on riskier borrowers, whereas 13% of Aussie borrowers have negative cash flow net of essential living expenses. This jumps to an incredible 49% of borrowers with high loan-to-income ratios and 32% of borrowers with high loan-to-value ratios. I shared a chart of that earlier. These borrowers are much more likely to struggle to meet their essential spending needs, the RBA says. And for all the talk of the fixed rate mortgage cliff being a myth, it is presumptuous to make that claim. The RBA advises that most borrowers who took circa 2% fixed rate loans have yet to roll to the floating rates that will radically increase their repayments. Specifically, 55% of fixed rates remain. In the RBA's own words, there is also a smaller share of fixed rate borrowers, less than 20%, who will roll off onto higher interest rates with much lower savings buffers, equivalent to less than 3 months of scheduled mortgage repayments. I shared that chart earlier as well. You can therefore spin this two ways. Either most borrowers are fine, or there are 1 in 5 who are screwed. In particular, the RBA assesses that 18% of fixed rate borrowers will have negative cash flows once they roll to variable, assuming no more hikes. This number is 7% of borrowers if one uses a narrower definition of essential expenses, excluding private health and school fees. The RBA also expressly warns about the coming high-risk debt default cycle and pain for non-bank lenders that have financed dodgier businesses and households, as we have done. After a period of fewer business failures, bankruptcies have risen in a range of economies, including Australia, Europe, and the US, the RBA says. In fact, US bankruptcy filings are at their loftiest levels since 2010. Now, this was all spelt out in a book by economist Lindsay David, Australia Boom to Bust. So if you guys want to go into more depth about what I'm talking about, go order his book. Now, another great book is The Land Boomers, The Complete Illustrated History by Michael Kennan, which I think was written in 66. I know it was written in the 60s anyway. And it goes through the history, the Australian history of land and house prices. And this is something I've studied. I've been studying the history of Australia's housing market because, most people have recency bias. I go back, I look at bond bear markets and look at how asset classes performed in those markets. I have no emotional attachment to any particular asset class. I couldn't care less. And if you want to get a bit of a summary of that book, Cam Murray did this piece earlier this year. Does Victoria's rollicking 1880s land boom have lessons for today? So he talks about Michael Kennan's book. So if you want, go Google that and have a read of that. Now, here's a great chart. So if you go back to that 1880s period, right? If you bought at the peak in 1889, not only did your home fall in value by about 40%, but you didn't get back to that price that you bought it at and maintained at that price until the early 1970s. So 80 years it took you to get back to break even and maintain that break even period. I'm not saying we're going back into that time period, but people don't look at this. People don't study this. And by the way, at the end of the war, why did house prices double in a year? Go check it out. Also, if you have a look at the 1970s boom or this period, like for example, from 1967 so 1974 to 79, house prices fell 16%. And then a couple of years later, 81 to 83 fell another 10%. Another couple of years later, 85 to 87 fell another 5.5%. And then 89 to 92 fell another 8.6%. So from 1974 through to the early 90s was a shocking period for house prices. And that's where I think we're probably looking at moving forward. A higher inflationary environment, a higher interest rate environment. And yeah, the only difference is the debt bubble now, the debt levels now compared to back then, like debt to income, debt to GDP, debt to what, is off the charts compared to back then. And this is an old chart, but mortgage debt, Australian mortgage debt to GDP is over 100%, and mortgage debt to income is over 200%. Now, for those of you who've been following me for a while, insiders will know that I do see a liquidity event happening, and I highly recommend you guys go and check out Joseph Wang, who was a former senior trader at the New York Fed. Check out his article published on the 18th of September about this liquidity event. And he just shares part of that. The potential for a replay of a March 2020 liquidity event in markets is on the rise as the rate of growth of debt continues to far exceed growth in the market's capacity to provide liquidity. The latest Fed financial accounts data shows that dealer warehousing capacity has trended higher, but still remains notably below GFC levels seen over a decade ago. And I thought I'd throw this in. The coming collapse of the global Ponzi scheme. And that's what our monetary system is. It's a Ponzi scheme. And, well, the banking system needs loan growth. It cannot afford to have a contraction in loan growth. And France's economy is heading into the toilet. Europe's buggered. And the UK as well. Eurozone economic downturn looms as business orders fall. UK recession risks increase as services activity falls. And in the UK, given short fixed rate periods, 35 to 40% of UK mortgages may see higher rates in the next 12 months. Resets are significant for both banks and borrowers, 6% new rates versus 2% rates in the back book. With higher utility bills, a 6% mortgage rate could mean that 30 to 40% of UK households struggle to pay their mortgage. Same for Australia, same for Canada. And in the UK, mortgage arrears have hit their highest level in the last 7 years, with British households falling further behind on loan payments after a surge in interest rates, with arrears jumping 28% in the year through June. And isn't this chart interesting with German home prices, or the home price index, and the ECB's balance sheet, or in particular their assets? What do you think of that correlation, guys? And yeah, you can actually see that Germany's home prices have continued to fall, along with Great Britain, but we've seen a bounce in the US and Canada, Australia and New Zealand, though New Zealand's been a little bit weaker than Australia, Canada and the US. And for my Canadian viewers, I had to share this. Greater Toronto home prices and main stages in a bubble. Are we about to see that big collapse phase?
A year ago, housing prices were sky high. It cost so much to buy a house in Vancouver that most people simply couldn't afford it. Now, even with interest rates coming down a bit, the combination of historically high rates and tight money is beginning to force down the cost of housing. Georges Tremel reports.
John McLaughlin moved back to Vancouver last fall. He paid $235,000 for this three-bedroom house. Today it is worth $60,000 less, and its value might still be going down.
I like the house. The area is one that I always wanted to live in, and I could afford it at the time, albeit marginally. And as long as the economy doesn't play any, doesn't wreak complete havoc with either my income or my wife's income, we will be able to continue to afford it.
The loss of an income can be disastrous. Selling the house can be impossible. If it has lost so much value, it is worth less than the mortgage on it. Real estate agents won't list it, and nobody will buy. The boom peaked with last year's high interest rates. Demand dropped off. Prices began to fall, especially the price of land. A building lot now sells for half of what it sold last year. Lower prices mean young couples looking for their first home are now buying again. This three-bedroom house in Port Coquitlam would have cost $150,000 a year ago. The butchers paid $93,000.
It really scared us to all of a sudden be this much in debt, but we're happy we did.
And we had it all worked out so that although we both are working, that we could manage on one salary, making the payments.
Mm-hmm. Has it proven to be that way so far?
Well, how many payments have we made? We've made 2 payments, so...
So far, not too bad.
The Vancouver market is now slowly getting back to normal. That's fine for the families who bought before the boom or are buying now. The families who bought at the peak can only wonder if and when they will recoup their losses. Georges Tremel, CBC News, Vancouver.
Now, most of you will know Eric Jung. Why do people think that oil and commodities will save Canada from implosion? It won't. Data clearly shows Canada has passed the point of no return. Number 1, never have Canada experienced a real estate bubble of this scale. When the Canadian real estate bubble implosion accelerates, the oil and commodities produced from existing Canadian natural resources companies won't be enough to cover for the GDP dump as a result of Canadian real estate bubble implosion. Number 2, Chinese companies and American companies will only pick up cheap Canadian companies after the dust settles, not before. 3, even your supposed saviors, the CPC, said that it is time to roll up your sleeves and pick up the pieces from the disaster the Liberals left behind. Number 4, stop your delusional dreams and be prepared. This is going to be unlike anything that Canada ever faced since the Great Depression. That's also a warning for Australians. And what he's talking about is Canada's growing debt. For every dollar of disposable income, the average Canadian household owes about $1.87. In Australia, it's over $2. So this is household debt payments to income. And he shared a chart from Ritesh saying, do you see the problem? Canadian dollar used to have a very tight correlation with crude oil, not anymore. So we don't benefit by rising crude oil prices anymore. Same sort of warning for Australia. So we need to be careful who we listen to. You know, all this talk of soft landing, soft landing, soft landing. How many times throughout history have we heard this? Yet people ignore Austrian economists who predicted every boom and bust for the last 100 years, which is kind of why I wanted to study Austrian economics in the first place. And this guy, I'm not going to say anything disparaging because I'm a Christian. House prices are surging because of low supply, he says. It's Economics 101. Look at Perth. All right, let's look at Perth. Now, you wrote this in October 2016. All right, we're looking, Mr. Cook, and 2016, Perth in yellow. House prices continue to fall, but I thought supply and demand. What's going on there? So it's interesting because the problem with this argument is it can't explain why prices started to rise in 1996 and skyrocketed from 2001 onwards. Annual population growth, and I should have mentioned this in the last video, but annual population growth between 96 and 2005 registered at approximately 1%, taking off between 1.5% and 2% from 2006 onwards, still much lower than Ireland. So fundamental supply and demand issues explain rent prices, not housing prices, which is why rents have increased from 2006 onwards. 2007 was the first time since 1950 that the population increased faster than the number of dwellings. The housing shortage argument was correct. Housing prices should have started to rise from around 2006-7 onwards, not 1996. But house prices started rising from 1996. So the historical data shows that there is no correlation, let alone causation, between population growth, dwelling supply, and house prices. And another reason why not to listen to these dodgy economists. This is the RBA cash rate from CBA. And they had a CBA cash rate forecast of 1.25%. They thought the cash rate would peak at 1.25% when I said 4.1%. And I'm not trying to, shower glory on me. I'm not doing that. I'm just saying don't listen to bank economists. In fact, a couple of ex-bank economists told me, Steve, we were employed by the banks. We do our employers' bidding, meaning we put the bank's interest first, which means we don't spook people. We always put a positive spin on things because we need people getting loans and we need loan growth. So we need to sell more loans next year than this year and so forth. So bank economists are just useless. And look, they're Keynesian, so what do you expect? They have no idea about Austrian economics. They have no idea about how the euro-dollar market works. Absolutely zilch. And in fact, interest rate changes, not supply, the key for house prices, an RBA paper says. Changes in interest rates are the primary driver behind the movement in house prices, not supply and demand, according to a Reserve Bank paper that appears to contradict the bank's governor. The most significant driver behind house prices and the level of construction was interest rates, says an analysis, a model of the Australian housing market by RBA analysts Trent Saunders and Peter Tulip. Most embarrassingly for the RBA, two of its top researchers, Trent Saunders and Peter Tulip, published a detailed academic paper shortly thereafter, proving that almost all of the stunning increase in house prices between 2013 and 2017 was indeed attributable to the reduction in mortgage rates. For the avoidance of doubt, the RBA economists demonstrated that housing supply and population growth had comparatively little influence. Just what I've been arguing. What I know with certainty is that the RBA's own research finds that a permanent 1% reduction in real mortgage rates will lift house prices by a stunning 28%. So now we are in reverse. What does that mean?
Recently, the Wall Street Journal published an article worrying that soaring yields on government debt could derail that fabled soft landing. We'd already seen rising warnings that bond yields could soar to double digits, which we last saw in the 1970s. Specifically, analysts are worried about the 10-year yield, which measures how much interest the federal government has to pay on its 10-year bonds. These are a big hunk of the national debt, but more important, the 10-year is a key benchmark for the cost of borrowing across the entire economy. So mortgages, car loans, business loans, even credit cards are all pushed up if the 10-year rises. If all of those rates rise, then companies and especially small businesses are choked off from lending, which is the standard trigger for a recession. What's worrying the Journal, what's really worrying all of Wall Street, is that the 10-year is hitting the highest level since the subprime mortgage crisis in August of 2007, which of course led to the global financial crisis. Moreover, the 10-year is soaring fast. In just 6 months, it's gone from 3.3% to 4.8%, meaning in just 6 months, it got almost 50% more expensive to borrow money going by the 10-year. Now, this is concerning because there's always a delay between higher rates and recession. The reason is because companies continue using the old cheap money that they already had. It's only when they run out and need new financing that they hit the wall and start dropping like flies. So a soaring 10-year is like putting up a brick wall 10 miles down the highway. You're fine for now, but something bad is coming. So why are rates soaring? There's two reasons: stubborn inflation and out of control federal deficits. The inflation makes markets think the Fed will keep rates higher for longer, while the deficit, which is currently on track to $2 trillion per year, make investors begin to wonder if Uncle Sam will actually pay them back. Incidentally, in case you had any remaining confidence in our economic leaders, the Journal quoted a number of experts, including Treasury Secretary Janet Yellen, saying they have no idea why the 10-year is rising. As Janet put it at a recent CEO conference, quote, "It's a great question, and it's one that's very much on my and the administration's minds." Top men. They'll need to pay some more professors, perhaps, to come up with new scapegoats. So what is next? Brought to you by Unchained. What's next is the coming months are going to give us two things that could pull the 10-year in opposite directions. On the one hand, soaring federal debt will continue, which will drive rates up. With yet another war to pay for, they could even get worse. On the other hand, we have a Fed running around like a headless chicken, flipping from hike to cut to hike. I recently mentioned Fed officials who were warning of yet more interest rate hikes, but they flip-flopped immediately after the Israel attacks to hints of rate cuts. Of course, they will have to flip again as inflation keeps going. At some point, investors will not believe Washington. They won't believe Uncle Sam will pay them back, but more important, they won't believe the Fed actually knows what it is doing. That richly deserved loss of confidence could overwhelm even Jerome Powell's mighty money printers, sending borrowing costs and the U.S. economy spiraling towards the catastrophic double-digit rates we last saw in the 1970s. Okay, we'll be watching. See you next time.
Yes, don't you just love the predictions of soft landings? Even Ireland, the central bank, predicted a soft landing for housing. And what happened? Well, check this out. And I'll throw this in our next video, but if you want, go Google this, type it into YouTube, debate between Morgan Kelly and Jim Powers prior to the Irish property collapse, and have a listen to Morgan Kelly in that. So, yep, Irish house prices fell over 54% from peak to trough. And, once again, on average, housing busts average 6 years to play out. Not 2 weeks, not 2 months, not 2 years, 6 years. So, we're in the very early days, folks. The pain hasn't even hit yet. Now, I'm not saying that Australian house prices are going to fall 54%, like the Irish house prices. I actually have no idea, and I'll never, ever put a prediction on what I think it's going to fall. 10%, 20%, 50%, 80%. You know why? Because that's a fool's game, and everyone who does always ends up getting proved wrong. All I'll say is I'm bearish house prices. So I argued in the last video that our immigration is not the cause of higher house prices, this bump in house prices. In fact, I showed you a chart earlier that shows new loan commitments, people borrowing. People have gone out and got loans because people have created their own FOMO. However, the Irish population leading up to the bust was far greater than our current immigration rate. Yet it didn't stop them. Their high immigration rate didn't stop their housing from busting. And eventually, when it did bust and people woke up, the people actually left and they had negative population growth. They had emigration. So, this whole thing that immigration, people are making it up in their own heads, and then they are rushing out to go and borrow. It's just empirical data does not back it up. There is no empirical data that backs it up. So if we have a look at US properties with foreclosure filings, so this is filings, there's a little uptick from very, very low. Remember, no one had to make their repayments. No one was being foreclosed on during the government lockdown periods. Watch this space. And US completed foreclosures, so this is completed, not filings, completed. Just starting to tick up just a little smidge. Now, let's go back to the peak of the GFC, right? The onset of the GFC. In the US, historical foreclosure activity and rates. So foreclosure filings and the foreclosure rate peaked at 2.23%. So many Australians think that half of Americans lost their homes. 2.23% were foreclosed upon. So remember those figures before where the RBA were saying basically 1 in 20, 5% of people literally cannot even put food on the table. Mortgage holders cannot even put food on the table right now. And actually, if you use a broader measure, it's actually 13%. And actually, if you use another measure, it's closer to 20%. So it doesn't take a lot of people to go bust for things to get nasty. And thanks to my buddy Tarek for sharing this chart with me. This is his work. So thanks Tarek. You can see that delinquency. So this is arrears. So as soon as you miss a payment, you're now delinquent. So in arrears. You can see that the peak of this 11.48% in January 2010. That's what it peaked. So you had 2.2% were foreclosed upon and 11.48% at the peak rate for mortgage delinquencies. This is arrears. But this is once the pain sets in and we're in recession, et cetera, and unemployment rising, etc. But this is a good chart to look at the growth of that. So if we go back, delinquency rate, arrears rate was under 2%. Okay, and then it didn't go above 2% until into 2007. And it didn't go above 4% until, the middle or the second half of 2008. And obviously peaked, in 2010, January 2010. But go back to the numbers that I shared earlier. The number of people that, the banks and non-banks and subprime in Australia, what their arrears rate is now at. Arrears rates, delinquencies are rising significantly in Australia. Look at the secret data that came out from the RBA, which none of us were supposed to see, with middle class people, upper class people, now struggling to make ends meet and using credit cards and all sorts of stuff. The amount of people that are now in negative cash flow, the amount of people who, have spent down their savings. Mathematics is going to win out. If interest rates remain elevated, mathematics is going to win out. And we're going to see mortgage arrears absolutely skyrocket in Australia. We're going to see people forced to sell. And if they won't sell on their own bat, the banks will make them sell. But we got a big problem in Australia because our banks are highly leveraged and exposed to mortgages, with almost 70% now of banks' balance sheets all focused on residential mortgages. And you compare that to the rest of the world, they're half what our banks are exposed to. So if our property market does significantly fall and we see arrears increasing significantly, we're going to see banks under huge pressure. And if we go back to 2007, the APRA bank stress test, APRA being the banking regulator, their scenario was a macroeconomic scenario with a China-led recession in Australia, 4% fall in GDP, house prices declined 35% nationally over 3 years, and unemployment rate increased to more than 10%. That's what the banks can handle. And then banks are like, ooh, are we even solvent anymore? And what do we have here? China fallout will hit Australia. Homeowners are crying, can't sell house even at half price. Home pricing drop in China. Check this video out if you want to see more. Home transactions in China's major cities during holiday fell 20% on year. And second-hand home listings in China's capital, Beijing, has reached 166,000 units as of October 6, hitting a new record high, according to real estate agencies. And bank credit in China to the real estate sector is falling through the floor. Industrial sector, however, is increasing. And China's banks may be loaded up with hidden bad loans. And Chinese investors scramble to sell overseas properties amid shaky economic conditions. As the Chinese property crisis continues and the growth of household wealth dwindles, some have had to sell their overseas investments. But with a saturated market and very few buyers, property owners are struggling to offload their foreign properties. And Shane Oliver from AMP, in his recent Oliver's Insights, titled China's Slowdown and Structural Challenges and Implications for Australia. Not going to go through it, but the key points: China's economy is slowing, not helped by a property collapse and long-term structural constraints around poor demographics and threats to productivity growth. China needs to save less and spend more, and this requires significant fiscal stimulus. So far, policy stimulus has been tepid, but a more forceful response is likely. Don't you just love the Keynesians? Chinese shares are cheap, but short-term risks are high. Absolutely. The risks around China's outlook means Australia can't rely on the China commodity boom indefinitely. And I've done some videos in the past about China. This video, will China dethrone the USA? And China's economic collapse, where I argue China's communist system, like all communist economies, ultimately collapse, and that China is actually headed more towards a Japanification, if I'm being honest. From Dun & Bradstreet, we estimate that Australia's federal and state governments are adding fiscal stimulus in 2023-24 worth around 2% of GDP or $50 billion. Outside of the GFC and government lockdown eras, that is the most since at least 1998-99 and sits entirely at odds with the 400 basis points of monetary policy tightening delivered by the RBA since May last year. We still think the RBA needs to hike further. Our terminal cash rate remains at 4.6% by December this year. 2 more hikes of 25 basis points at each of the November and December meetings. Fiscal policy working in the opposite direction to monetary policy only adds to the case for further hikes, and I tend to agree. Now, Glenn Stevens, who's the Macquarie chair and former RBA governor, says interest rates seem likely to be higher and for longer than most people envisaged, with the associated prospect of weak economic outcomes. And his predecessor, former Reserve Bank Governor Ian Macfarlane, has given a hawkish assessment for the outlook for inflation and interest rates, where more rate rises are likely, says the ex-RBA boss. And RBA interest rate rise on horizon as rate cuts expected are delayed. And the new RBA Governor, Michelle Bullock, says inflation is still too high as she warns about interest rate rises. And in their latest minutes, the board has said they have a low tolerance for a slower return of inflation to target than currently expected, which was out to 2025. Can you believe it? And the RBA has been betting against the world on interest rates. The prospect of higher for longer interest rates is hitting financial markets and raising questions about whether the RBA's less aggressive interest rates than overseas can last, because it's putting downward pressure on the Aussie dollar. But Chief Wiggin wouldn't know anything about that. And falling Aussie dollar ups pressure on Bullock to resume rate rises. And here's a warning that the Aussie dollar could drop to 40 cents to the US dollar. And that is bang on with where Brent Johnson, the dollar milkshake man, thinks the Aussie dollar's going as well. And that means if the Aussie dollar does fall down to those levels, that our consumer good input prices will remain and maybe even increase, putting much higher pressure on the CPI, meaning that the RBA are going to have to lift rates, or we're going to find ourselves in a very interesting currency crisis. And you can see here from this Westpac chart that asset managers and institutional investors are very bearish the Aussie dollar. Leverage funds have only just started becoming bearish again. So you guys know that I've got this liquidity event situation that I believe is going to happen, and I am set up for a fall in the Aussie dollar, and I'll capitalize on that. And for everyone who is wishing that central banks cut rates, do you really want to wish that? Because central banks only cut rates when there's pain. And you can see all these Fed pivots. Have a look at what happened to the S&P 500. Central banks cut because there is massive pain. They're not going to cut beforehand. Especially when we've got a CPI problem. Like, seriously. Now, everyone's talking about the Minsky moment, etc. I don't subscribe to Hyman Minsky. I'm not a Minsky guy. In fact, I know people have been talking about this Minsky moment for, 20, 30 years now. I don't know. We'll see. And house price rally, not sustainable, warns economists. The recovery in property prices led by surging population growth and a severe housing shortage. See what they do. Could prove short-lived if unemployment rises and the Reserve Bank keeps the cash rate high, economists warn. Stephen Anthony at Macroeconomics Advisory is also sceptical about the robustness of house prices. It is more a reflection on the long and variable lags of monetary policy, he said, noting that the government's large increase in temporary visa holders has swelled the pool of demand for rental accommodation and soaked up the inventory of unsold housing stock. Well, listings are at very, very low levels, so wait until those listings rise. But it's definitely created a rental problem. And Warren Hogan, first signs of the narrative pivot. Oz house prices or price expectations to September were hilariously bullish. I am worried that the recovery in property prices is a false rally. And David Oldmate of Better Shares echoed the view. He used to work at Treasury. At best, prices seem likely to only level out rather than fall back all that much. He said he noted that this year's rally partly reflected the fear of missing out. Absolutely. The FOMO. I'm telling you, every client that we see have FOMO, whereby investors buy the dip on expectations that the RBA is nearing the end of its tightening cycle. But don't hold your breath. Jarden's chief economist, Carlos Cacho, estimated that households have been hit by a 30% reduction in borrowing capacity amid the worst affordability on record. Actually, in some cases, it's nearly 40% reduction in borrowing capacity. The two key risks for the housing market are higher rates for longer and a material increase in supply. Wait for people that need to sell. Listings are going to rise, folks. Many borrowers were optimistic that the RBA would start cutting rates sooner rather than later, he added. People wishing, people dreaming. Wait until the second half of this decade. Oh, people are going to have fun then. Goldman Sachs expects the housing market to materially soften, reflecting additional tightening by the RBA. The bank's chief economist in Australia, Andrew Boak, forecasts one more rate increase in November in response to sticky inflation. AMP chief economist Shane Oliver also expects property prices to slip as a pickup in unemployment leads to distressed sales. A further rate hike and delay in rate cuts next year would add to the risk. Rate cuts are only coming if something breaks and we have severe pain. And at that point, things aren't going to turn around straight away. There's going to be more pain to play out. They're not going to cut when we've got CPI at the levels we've got. It's not happening. It's just not happening. So really, it comes down for me, the Austrian business cycle theory. If that's to be believed, then I'm bearish house prices. And the Austrian business cycle theory has got most booms and busts right over the last 100 years. The bond bear market, I believe we're in a bond bear market. I think the 40-year bond bull market is over. And I also think due to the government's energy policies and the hollowing out of our economy, we're going to see much, much higher interest rates in the second half of this decade than they are right now. We might see some rate cuts into 2025 as things break. But then later this decade, we're going to have a very serious problem with energy and CPI. Corporate bond market, well, zombies just can't stay afloat with these kind of interest rates, even if rates don't rise anymore. As those corporate bond matures over the coming years, they won't be able to refinance. They're going to go under. That could also bring down probably some solvent companies as well, which is going to lead to higher unemployment. And if there's higher unemployment, how are people going to make? If people are already struggling to make their mortgage repayments today with two incomes, etc., how are they going to do it when they lose one household income? And they're down from two to one household income. How are they going to afford it? So that's going to be bearish housing. Immigration, this talk of immigration, just all the data just doesn't show me. It just doesn't prove. It didn't stop Ireland, which had a higher immigration rate than Australia. RBA research paper shows that immigration supply and demand is not a factor. Empirical evidence, hundreds of years of economic evidence has shown that it's house prices are a derivative of income and the leverage applied, i.e. borrowing capacity. And mathematics on household finances. This cannot play out. You cannot spend more than you earn, spend all your saving. Like, there is a limit and something has to give. Mathematics will win out. So for me, it's history, mathematics, and economic laws. That's what I'm betting on. Most people, most Australians, most Canadians, most Kiwis, most Americans, most of the British, most people throughout Europe and everywhere else are betting against history. They're betting against mathematics, and they're betting against economic laws. So, yeah, that is me, folks. That's this series done. This is why I'm bearish. You may agree, you may disagree. Next week, I will share another video just with bits of information and clips I'll just put together that I just didn't have time to put in this series, because this series has gone long enough. This video is a big, long one. The last one was a long one. There's just so much information to share. So hopefully, whether you agree or not, at least you know why I am bearish real estate, why I have put my money where my mouth is, and I have sold all my investment properties. I have 0 investment properties, and I'm not emotional. I don't get emotional. I don't love any particular asset class. Even people say, you know, I'm a gold bug, and yeah, I'm a bit of a gold bug, but I've done the wealth cycles. I've sold silver before, and I'll sell silver again. Yes, I've got a lot of silver at the moment. I've got a lot of gold at the moment. I will sell that at the right time. I don't fall in love. I don't marry any particular asset class. I just date them. Anyway, guys, I hope you enjoyed this series. Take care, everyone. I'll see you all again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor, having regard to your own objectives, financial situation, and needs.